Flexicap is a very powerful concept. If large caps are outperforming, it will buy large caps. If mid and small caps are outperforming, it will buy mid and small cap. If you want one fund to solve for market capitalization, timing, quality and concentration, and that too at a low cost, I think this is the fund for you. So when investors come to equity markets, usually they come up with a number of challenges. The number one challenge is to find out where to invest. Large cap, mid cap, small cap. That is the number one question that people have. And then they also have to think about how much to invest in each of these categories. And then they think about when to invest. What is the right time to invest in smaller companies or the larger companies? Because if they do it on their own, let's say they have a large cap portfolio and they want to enter small and mid cap, when they sell these companies, they end up paying taxes. The churning causes them to pay taxes. If they underperform by doing all of this, eventually they go through behavioral issues where they do not know what to do, right? If they chase performance and underperform, they end up holding investments which are subpar. So even if an investor solves for all these problems, sometimes the costs are very large. Not only taxation, but transaction costs are very large. So an alternative which can solve for which type of market cap to buy, when to buy it, in what proportions to buy, one such strategy is Nifty500 Flexicap Quality 30 Index. So Nifty 500, which is the first 500 stocks by market capitalization, it covers all three segments: large cap, mid cap and small cap. So this index, which is Nifty 500 Flexicap Quality 30 Index, first looks at which segment of the market is doing well. So for example, if large caps are outperforming mid and small cap, investors would want more exposure to large cap. So by using a formula which gives you what is called a relative momentum, for example, if mid and small caps are outperforming large cap, the momentum should tilt in favor of mid and small cap. So what this index will do, it will give 2/3 weight to mid and small cap stocks and 1/3 weight to large cap stocks, which means this is a relative momentum play based on the market momentum. Currently, the momentum which market plays or gives you to invest is based on stock specific momentum. This is a market wide momentum, and we believe breadth momentum or market wide momentum is a much stronger way to play momentum. So once this is solved, then you go to the second leg. The second leg tells you quality companies. It selects 10 quality companies from each segment, which is large cap, mid cap and small cap, and then gives appropriate weightages. In our example, the higher weightage, which is 2/3 weight to small and mid cap, which means 10 mid cap companies and 10 small cap companies. These 20 companies will have 2/3 weight in the index. Then comes the step number 3. Step number 3 is nothing but concentration, which I already said 10 companies each, and that's why this index has concentration, only 30 companies in totality forever in the index, and that makes this index qualify for 3 factors. First, as I said, Flexicap, which is nothing but a relative momentum. Second is quality, which is all companies in the index are only quality companies. And third, which is concentration, you are only holding 30 stocks in the portfolio. That's how 3 potential factors play out in this index. In mutual funds, Flexicap funds hold special meaning. You will see a lot of managers have this specific use case where they can traverse mid cap, large cap, small cap universe so as they please. If they see opportunity in one capitalization, they will tilt towards that capitalization. So Flexicap is a very powerful concept. How this index uses it is by using a term relative momentum. What do I mean by that? If one capitalization is in better momentum than the other, this index would want to overweight on that. So let's take an example. For example, if large caps are outperforming mid and small cap, and how do you calculate outperformance? Let's say if large cap divided by mid and small cap ratio, which means stock number 1 to 100 divided by stock number 101 to 500. If this ratio favors large cap, that means it is time to buy more large cap stocks. This index will tilt in favor of large cap stocks in that case, giving you what is called relative momentum. In today's market, people play momentum through stocks, which means buying single securities which are outperforming the market. What this index does is it buys the whole segment. So if large caps are outperforming, it will buy large caps. If mid and small caps are outperforming, it will buy mid and small cap. And historical data shows that in most bull markets, when mid and small cap outperform, the large part of alpha in most portfolios come from these stocks. So this allocation to mid and small cap, when they outperform, can go to even 66%, which makes this index a true flexi-cap index, because in case of most flexi-cap strategies, you will not see allocation going up to 2/3 or 66%. So this is what makes it unique relative momentum play. So quality companies are those companies which have low variability in businesses. And how do you calculate low variability? First is you look at how variable their profit profile is. Do the profits vary too much from year to year? Second is how indebted are these companies? Do they hold a lot of debt? You want companies to hold less debt. And third is, what is the return on equity? Is it healthy? Is it high? If companies who have high debt to equity, they will not be part of quality universe. Only companies where variability of earning is lower, indebtedness is lower, and return on equity is higher will be quality companies. I'll explain by an analogy. So there are two types of companies. One where you could name them as tennis balls, the other you could name them as eggs. When you throw a tennis ball, it will bounce back. But if you throw egg, it will not bounce back. So quality companies are in that sense like tennis balls. Even if there is a tough environment, they will fall, but they will come back. And that's why quality is very, very important in any portfolio. So concentration is a very important strategy. We've seen that if you can achieve good or similar results by using a set of portfolio companies, you don't need to overly diversify, right? So how do we use concentration in this index? We look at each set, for example large cap, and have only 10 companies from that aspect. So the index is already filtered for quality. So you will pick only 10 largest quality companies. And similarly, you will pick 10 largest mid-cap companies, again scored for quality. And third, again pick 10 largest small-cap companies, again scored for quality. So how does concentration work is that it ends up picking bigger companies in that segment and concentrating your portfolio to only 10 companies each by segment. Now, why this is important? Think about the macroeconomic landscape. In any country, the corporate sector goes through cycles, but these cycles are managed by three distinct flavors. First, macroeconomic stability, second is scale, and third is ROE. You can only choose two of them, which means that if a country chooses macroeconomic stability and ROEs, it will find it very hard to scale up. That means the companies will not become very big. For example, in case of India has chosen sort of macroeconomic stability and high ROEs, high return to shareholders. Therefore, Indian companies are extremely profitable. Now, what does this mean? That any companies which have high scale or have advantages of scale will be a sought after investment in India. It will enjoy possibly higher valuations and probably more love from the stock market. This concentration allows you to buy more such companies. If you look at the construct of the index, companies in this index will have higher quality, which means higher ROEs. In fact, the index companies put together has roughly 1.5 times the ROE profile of NSE 500 or Nifty 500 stocks. So therefore, concentration sort of gives you a feedback loop of quality and flexibility that is built into the index. So in DSP Netra, we have showcased that SIP is a strategy which has outperformed across time frames, across markets, across the world, and it remains one of the best strategies to invest. Why? Because it takes care of all the volatility and all the behavioral mistakes that we make. This particular index is probably one of the most suited strategies for doing a SIP. Why? First, this index solves for market capitalization issue where you don't have to think about what you are buying, large, mid or small. Second, it takes care of the timing issue by allocating appropriate amount to each market capitalization. And then it also takes care of the concentration risk, which means that where do you invest, how much to invest in each company. So once you answer all these questions, the only risk left is the time risk, which means that if you face volatility, how do you solve for it? And we've seen in the past when there are large drawdowns, people make mistakes. Investors make mistake of redeeming very early or redeeming too late. So once having solved for all the problems that I stated earlier, SIP in this strategy becomes very, very powerful. If you want one fund to solve for market capitalization, timing, quality and concentration, and that too at a low cost, I think this is the fund for you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.